Okay, welcome back guys. Last lesson we were looking at the internal sources of finance, and the main one internal source of finance being retained profits. So those profits kept from previous years that the organisation can use to for whatever it chooses, acquisitions or the like. Okay, today we're going to move on to external sources of finance. So there are many external sources of finance. So places outside the business where that business can go in order to access capital or access money to do whatever it needs to do with those funds. Again, often it is for acquisitions, often it is to buy it, but it may well be to buy stock, to even pay wages, although you really wouldn't want to be borrowing to pay wages because a lot of external finance is debt related. So this video will just focus on external source of finance being debt, and we'll focus on short term. So three main short term sources or types of external finance in the form of debt. Now, remembering, like with current assets and current liabilities on our balance sheet, our short-term borrowing is for periods up to 1 year. So anything longer than that is considered to be a long-term source of debt finance. There are three main types of short-term borrowing. There's an overdraft, a commercial bill, and also factoring. And we'll go into a bit more detail about what each of those are. Okay, firstly, an overdraft. Again, something that we've spoken about when we've been talking about our current liabilities, because that's one of the two main current liabilities an organisation might have if it has undertaken an overdraft. So what is an overdraft? It's where a bank provides a service allowing the business, in this case, to be able to overdraw its bank account to a agreed level. I gave the example in class last week of a business that is seasonal. Now, that business that is seasonal needs capital to be able to buy its stock, so that it has stock to sell in that particular season. You know, think about a snow hire business or a ski hire business. If it doesn't have stock, the business doesn't exist. If they don't have enough money to buy that stock, the business isn't going to exist. So they may well go to their bank and request and ask for an overdraft. And the bank may well say yes, and if they do, they will charge them a relatively high rate of interest and require that those funds be paid back in a relatively short amount of time, generally within 6 months. So in brief, that's an overdraft. Factoring is another external source of debt finance for the short term, whereby an organisation goes to a factoring firm and seeks to sell their accounts receivable balances at a discount to what those accounts receivable balances are worth. But the advantage is they'll get the funds generally within about 48 hours if they can find a factoring firm to buy them. So if you think back to Irish Toys when we were looking at their balance sheet, they had some accounts receivable. If they're short of funds, they need funds quickly, in the short term, they may well go to a factoring firm and ask them, will you buy these accounts receivable from us? We've got, let's say, $100,000 of accounts receivable. Will you buy those for us at, let's say, $90,000? They get their $90,000 hopefully within 48 hours. And the advantage for the factoring firm is that hopefully they can get all those accounts receivable paid to them at $100,000, and they've just made a fairly quick $10,000. That's it in an ideal world. It might not work like that, but that's what factoring is about. So here's just an example. If you go to the ANZ website and type in business overdraft, they have a page there which showcases what their overdraft options are. So some of the things they say, that there's a minimum of $2,000. The maximum they don't tell you on their website. You'd need to speak to a business relationship manager there, and they might come up with some sort of maximum amount. There's no minimum or maximum term, although like I said before, it's generally 6 months, and they don't disclose their interest rates because they are variable depending on the quality of the customer. In terms of factoring, here's just an organisation I found who does factoring. Like I said, it's the selling of accounts receivable, and there's some information there if you want to Google Scottish Pacific Business Finance. They're an organisation that do provide that service. Now, I've left commercial bills to last because they are generally the most confused type of short-term debt finance as an external source, and that students find this. So a couple of key points about a commercial bill. Number one, it is generally unsecured. So that means there is no there is no property secured to this particular source of debt finance, which makes it higher risk because no collateral has been held as security. Remember, with a mortgage, for example, although it's long term, it does have collateral, i.e. property, attached to it, and that's why the rate of interest is lower. It's short term. We've been generally 30, 60, 90 or 180 days, and it's generally for amounts over $100,000. Now, these commercial bills are generally issued by a corporation, so entities that specialise in these types of securities, and it's generally for the financing of stock. So if an organisation is short of stock, a retail store, for example, and they need to go and buy some stock, they may well be able to access a commercial bill, which will allow them to meet that short-term liability of buying that particular stock. Now, the one unique thing about a commercial bill, it doesn't have to be repaid until maturity. So it doesn't have to be repaid, repayments are paid every month, for example. It's not repaid until maturity. And as that last point there says, the borrower receives the money immediately and they promise to pay that back at a future date. Now, because it's unsecured, like I said earlier, there is a higher rate of interest. And as there's no collateral, the entity who's providing the commercial bill will definitely want compensation, and that's why they charge a higher rate of interest. Okay, that's it for short-term borrowing. The next lesson we'll move on to long-term borrowing.